We've got very strong line of sight to cash generation sources that are materially above the sort of imply. If we implied a continued 3% dividend growth rate, we keep paying the debt coupon. That amounts to about 250 million of cash that's required. Our underlying cash generation sources are materially above that.
Hello, you're watching Proactive. Joining me is Chesnara CEO Steve Murray. Steve, very good to speak with you. You're after your 2024 results today. It looks like a great year for Chesnara. Strong cash generation, and of course, that continued dividend growth.
Yeah, we've just finished speaking to investors and analysts, and that was certainly the message that we were giving to them. That strong cash generation of 60 million, which has also got strong dividend coverage as well, was well received. We grew the overall value of the business during the year as well, which I think was also positively received. And we've continued to have a strong and stable solvency level. And as you say, I think a number of investors like the consistency of the dividend policy, and that sort of 20-year consistent growth track record is the best in UK and European insurance. So it was a good set of numbers to present this morning.
And one point that was brought up by analysts, Steve, was your judicious deployment of capital, and particularly pertaining to the Canada Life deal in December, which has worked out better than expected.
Yeah, so the uplift in economic value, we gave an update to the market saying that was 11 million versus the 8 million that we talked about just before the festive period. We did say to analysts, you can see that people at Chesnara keep working right the way through to the back end of December from the date that we announced that. And what we saw was when we sort of went through our full year procedures with more data, we're able to manage that book a little bit more efficiently than we were initially expecting. We've probably seen a little bit more market growth coming through. So it was nice to show that people that already were probably seeing a little bit more value from that deal. And the consideration there was 2 million. So we were saying to investors and analysts, paying out 2 million to see an uplift in the economic value of 11 million felt like a sensible deal for us to be doing for shareholders.
And you pointed out your Solvency II capital ratio, 203%, so it's well above your operating range, Steve, and obviously gives you lots of headroom to make more such acquisitions.
Yeah, that's right. And one of the things that we've been talking to the market about is the positive pipeline, and it's great to be in that position, as you say, that solvency position strong. It gives us that headroom. We have around 200 million of readily available firepower for acquisitions at the moment. So a number of the things that we need to be and have in place internally, thinking about the strength of the balance sheet, those capital resources are certainly there for us. And combining that with what we think is a pretty positive market, we've been certainly saying to analysts and investors this morning that we remain positive about the outlook for further M&A.
We chatted about this before, Steve, and you said there'd been a pullback really from private equity, which was opening up more opportunities. Where are you seeing these opportunities at the moment?
Yeah, so we're still seeing that. I think when I first joined Chesnara over 3 years ago, there were more private equity firms trying to sort of invest more directly in some of these acquisition opportunities. I think we're still seeing private capital providers in our space, but quite often now in partnership with other insurance companies. We actually saw a large deal in Germany last week where there was a consortium of bidders, including insurance companies, private market providers as well. When we're looking at opportunities, we're seeing good opportunities in the UK and wider Benelux, including the Netherlands. So this continues to be large insurers trying to simplify their business models, perhaps take capital from one part of their business to reinvest in the other. So in the UK, a lot of people are looking at this bulk purchase annuity space where insurers are providing insurance contracts to DB pension funds. We've seen a lot of activity there. So if the insurers can free up capital to deploy on that from selling portfolios, that could be quite attractive for them. So we've seen sort of some of the trends we've talked about before continue, and we are seeing things in other markets as well. And we'll always keep an eye out for sort of value accretive opportunities outside our existing territories also.
How about the economic landscape at the moment, Steve? It does seem pretty uncertain. Tariffs being introduced in the United States. We had the Chancellor's spring statement yesterday. Any thoughts on that and the way forward for the economy?
Yeah, so I was actually in board meetings when the Chancellor was speaking, but I've sort of seen the transcript and look, there is clearly an understanding from the government that there's a need to improve the growth of the economy and sort of free up opportunities for people to invest capital. So we sort of welcome those words warmly, and I think we're seeing that in Europe as well. I think more broadly, one of the things that we tend to do is, of course, we'll look at the short-term volatility and noise in the market, but because of the length of contracts that customers have with us, we're a bit more focused on the medium and long term. And actually, even with the noise and volatility that we've seen in the market, actually overall, markets have still performed pretty reasonably in the first part of the year. And we can also look at that with a balance sheet that's got some really natural hedges in it, where we can withstand some very material moves in equity indices, credit spreads, inflation rates, and those sorts of things. So I think, like everybody else, we're sort of keeping an eye on this, making sure that we're front-footed in the approach. But actually, we're much more concerned about how this might flow through into the medium and long term, and we're sort of comfortable with the asset strategies that we have and the positions that we have in markets to take account of those things.
How's 2025 looking so far, Steve? Are we looking at a 21st year of dividend growth?
Well, one of the things that we talked to investors about this morning was the sort of strong sources of cash that we have and line of sight that we have, and what we say to, we actually show them a slide that we use with our board, which looks at the sort of 5-year cash generation picture and where those sources are. So we reconfirm to the market to say, look, we've got very strong line of sight to cash generation sources that are materially above the sort of imply, if we implied a continued 3% dividend growth rate, we keep paying the debt coupon. That amounts to about 250 million of cash that's required. Our underlying cash generation sources are materially above that. So we think people can take a lot of comfort that that cash generation has come through this year, and we expect it to continue to come through in the future.
I hope you'll keep us updated on any progress. Steve, thank you very much for taking the time today.
Great seeing you, Stephen. Thanks.
Steve Murray, the CEO of Chesnara.